I was thinking this morning about the natural tendency of people to buy investments when they are hot and sell them when they are cold. After doing a little internet searching, I came across an interesting Dalbar research study published in 2016. The study summarized purchase and sale records from mutual funds to quantify how the average investor in stocks and bonds performed relative to the benchmarks that are relevant to their investment vehicles of choice. The information is very eye-opening, and I'm going to go through it briefly and then discuss how the information might also pertain to an individual who buys non-mainstream assets such as gold, silver, or even Bitcoin. What we see here is one of the key tables showing how the performance of investors in stock mutual funds compared against the S&P 500 index, and how investors in bond funds compared against the Barclays Aggregate Bond Index. The top row is probably the most interesting because it aggregates the average results for the long-term 30-year horizon. Notice that while the average annual return over the past 30 years for the S&P 500 index was 10.35%, the average investor in stock mutual funds only earned 3.66% per year. This is an amazing shortfall. The average person who invested in stocks didn't come anywhere close to earning the rate of return often promoted by stock market enthusiasts. The Dalbar study went into some detail about the reasons why, and I'll cover them in a moment. But just so that you don't think that this is a stock-only phenomenon, you can see that while the average yearly rate of return for the bond index was 6.73% per year, the average investor in bond funds only earned 0.59% per year, not even exceeding the measured rate of price inflation. For the sake of time, I won't discuss the results shown for the shorter periods of time, but if you pause the video, you'll be able to see that the results are not encouraging for the average investor in paper securities. One thing worth noting, because it will be used in the future slides, is that the 20-year underperformance of equity investors who earned 4.7% per year versus the market's 8.2% per year is a 3.5% per year underperformance. Because the Dalbar study has been conducted for many years, they were able to show this chart of long-term returns of individuals purchasing equity mutual funds relative to the S&P 500 benchmark. Immediately, one can see that long-term returns of the individual who decides to play the game is well short of what financial advisors suggest that the equity investors should be able to earn. It's been the same story year after year. Rather than a fluke of timing, it is a consistent story of poor performance. So why do investors who decide to play the game fail to reap the rewards of financial markets that they are told that they are entitled to? Well, here's one key reason. The average person who buys financial assets is really their own worst enemy. As is shown in this chart, the relative amount of funds held in money market accounts tends to increase as stock market prices fall, and the relative amount of funds held in money market accounts tend to decrease as stock market prices rise. Investors tend to panic and sell their stock market investments and ride out the storm at precisely the time when prices are low and stocks present a more compelling value. Once the stock market recovers, after a significant period of rising prices, our investors then decide that the time is right to move their money market assets back into the stock market. However, this time, their fear is that they will miss out on further gains. Many of Dalbar's statistics support this evidence that individuals tend to be swayed greatly by emotion, and thus they buy and sell at precisely the wrong times. Though there are other reasons why individual investors in stocks and bonds tend to do very poorly, and let's see what they are. Remember a couple slides ago that I mentioned that the most recent 20-year period had individual investors underperform the market by 3.5% per year? According to the Dalbar statistics, poor market timing is the number one contributor. The tendency to buy high and sell low accounted for a full 1.5% per year of the underperformance. There are other contributing factors. About 0.8% per year of underperformance was due to investment expenses. In the world of mutual funds, these expenses would be in the form of sales loads and expense ratios. Sales loads are one-time expenses paid when buying and selling a mutual fund. Expense ratios are management expenses paid by the investor to the mutual fund company every year. These expenses are usually charged based upon the total value of funds held by the investor. This 0.8% level is very interesting because many investors choose to invest in low-cost index funds, which generally charge 0.2% or less per year, which means that if the average investor incurs expenses of 0.8% per year, then there must be lots of investors who choose to buy mutual funds which charge much higher fees than this 0.8% per year. So what, you might say? 0.8% per year is not significant. Well, it might not seem that way, but at the end of 20 years, it's the equivalent of forfeiting 17% of your wealth. To put this in perspective, it would be like paying a 22% premium for a coin when it could otherwise have been obtained for a 5% premium instead. Now, the remaining reason for personal investors not doing well as the market is liquidity. Everyone has times in their life when they need some cash. The statistics bear out that because some investors fail to buy because they don't have the cash, and other investors are forced to sell because of a sudden need for cash. This need for cash explains another 1.2% per year shortfall in performance for our individual investor. So to summarize, why is it that individuals do so poorly in the financial markets? The primary reason has to do with timing. Individuals tend to buy when the market is high and everyone is excited, and they sell when everyone is panicking and the market is low. Part of this is human nature. High prices tend to attract attention and increase everyone's confidence that they can share in the profits that others have already realized. Falling prices tend to cause investors to become pessimistic about financial assets, just at the time when these assets should be viewed as more attractive in terms of their future prospects, simply because they can be bought at bargain prices. Now, aside from personal emotions, there are times when investors are forced to sell at bad times because of emergencies that come up. When cash is needed for expenses and liquid assets are not available, then the investors are forced to sell the assets that they do have, regardless of price. And the other big factor is that they just pay too darn much to participate. Fund managers have an envious job. They can collect high fees regardless of performance, and they earn a pretty high rate of return on other people's money, not their own, which is a pretty sweet deal, huh? And all of this excludes the tax implications of investors who buy and sell. Taxes are a real cost that has to be included for consideration, though the Dalbar study did not include them as a factor. So, do all of these factors apply to the purchase and sale of non-financial assets, such as gold, silver, and, let's say, Bitcoin? Let's explore this question a little bit. Be prepared, though. The psychological forces and liquidity issues that lead to poor timing in the equity and bond markets are universal. There really is no reason to believe that our precious metals community is immune to them. And we also have costs as a factor in our purchases as well that will act as a drag on our performance relative to quoted spot market price trends. Let's start by taking a look at the popularity of silver as an investment. I'm sure there is other data available out there, but this will suffice for the discussion. Here is a Google Trends summary of searches for the term silver investing. Notice that the internet searches for silver investing hit a peak on April of 2011. It also reached a couple of minor peaks in April of 2006 and in March of 2008, but April 2011 was the big one. Now, what is the significance of these dates? Well, anyone who has been a silver owner for more than a year or two probably already knows, but let's take a look at a price chart. The price chart for silver tells the story behind investor enthusiasm. Notice the giant price spike in April of 2011, which corresponded with the popularity of internet searches for silver investing. Coincidence? Probably not. Price tends to influence behavior, and when the price of silver broke $30 per ounce and rocketed to close to $50 per ounce, it drew a lot of attention to silver as an asset, and a lot of people entered the market only to be disappointed over subsequent years. There were also price spikes in April of 2006 and in March of 2008, but they were somewhat minor compared to the run that was seen in early 2011. The trend in searches for the term gold investing can be instructive as well. There were spikes in 2006 and 2008, just as was the case with silver investing, and another spike in August of 2011. None of these spikes were as pronounced as the April 2011 spike for silver investing, but they are notable spikes just the same. And if the cause of this was investor enthusiasm, then we'd expect to see notable peaks in the price chart for gold. We would also expect that there would be more searches for gold investing during the period of time when the gold price was rising, and fewer searches when the gold price was falling. Notice that the relative level of searches for gold investing is higher here in the period leading up to August 2011 than for the period of time from the beginning of 2012 to the end of 2015. Sure enough, we see these expected features in the price chart. The peak in the gold price was observed in August of 2011. This was the likely cause of the peak in popularity of the search for gold investing on the internet. The rising price trend prior to that date attracted more people to gold as an investment. And we also had a couple of minor price spikes in 2006 and a couple in 2008, which attracted more potential investors into this market. So gold investors are no more immune to poor timing impulses than silver investors. So what about the people that choose to buy Bitcoin instead? Here's a trend chart of searches for the term cryptocurrency. Notice the giant spike in popularity of this search term in December of 2013. After this date, the popularity of the term dropped significantly, but it did not fall into obscurity. It hit a trough in the years 2014 to 2015, and then started rising again until it hit another peak in January of 2017. Now, if we look at a price chart of Bitcoin, would we see a price peak in late 2013 followed by a falling price into 2015, followed then by a gradually rising price into 2017? Let's find out. Yep, there it is, plain as day. The price of Bitcoin topped $1,000 for the first time in late 2013, inspiring lots of people to buy Bitcoins. There were even comments back then about Bitcoin becoming more precious than gold. I'm sure it is for some people, but I suspect price influenced some people's opinion about the merits of Bitcoin as an investment as much as any other factor. Many who decided to take the plunge into Bitcoin at the peak in the market were disappointed over the following 2 years until the price trend started reversing again. Gradually, the higher and higher prices of Bitcoin drew more people into the market until the price exceeded $1,000 per coin once again in early 2017. Will the price continue to climb? I have no idea. It might fall. The point of this exercise was to examine how rising price trends tend to attract people's attention. Falling price trends result in waning enthusiasm. This is true whether we're dealing with stocks, bonds, gold, silver, or Bitcoin. It's really a feature of human nature, leading to certain behavior. This behavior runs counter to what prudence would suggest. Generally, investments have better potential when they are not popular and thus priced cheaply. So we can see that impulsive behavior can be the enemy of those participating in alternative markets and thus a drag on individuals' performances in these markets. What about costs? Do the same factors apply here as apply in stocks and bonds? Of course. I know that everyone tends to get very emotional when specific coins are brought up as examples of exorbitant premiums, and I totally understand. The theory goes that for well-selected coins of limited mintage, that the premium will not only be recaptured upon sale, but the premium might also expand and increase the profit of the holder of the coin. I get it. Certainly I've seen that some collector coins have done very well over the years. I've also seen just as many, if not more, coins which were bought for heavy premiums, only to fetch close to spot many years later. Do I have an eye for which coins will do well and which will do not? Nope, nor do I claim to. My own personal preference is to buy low premium bullion coins, but that's certainly not the only way to approach bullion assets. Just the same, everyone needs to be aware of the impact that costs will have on a person's investment performance if the premium paid at purchase is not recaptured when the time comes to sell. I've put this table together to illustrate a point. The very left-hand column of the table is the premium paid for a coin relative to what is recaptured at sale time. The top row of the table represents the holding time for the coin in years. Every number in the table represents the yearly appreciation that's required just to make up for the premium paid. For example, a person who buys a gold eagle at a price that's 5% above spot and then sells it 10 years later for spot at the local coin shop would need for gold to appreciate by about 0.5% per year to recoup the premium. One can think about this 0.5% per year as being like an effective cost associated with holding the coin. It's slightly less than the 0.8% per year management fee paid by the average equity investor, but it's significant nonetheless. And obviously the gold maple buyer, who pays a 4% premium and holds for 20 years, will find that he or she gives up far less wealth to the mint and to the coin vendors. What about somebody who buys a silver eagle at a 15% premium in the hopes of selling it for a profit in 2 or 3 years' time? Silver would have to rise at a rate of 5 to 7% per year just for the investor to break even. And that's a pretty big headwind in terms of performance. Certainly buying the silver eagle with an idea of holding it for 15 or 20 years will decrease the burden associated with the higher premium. So, how can you use all this information from this video to your advantage? I guess that's really up to you. For me, it just reinforces some of the ideas that I've developed over the past 20 years of making mistakes and learning from them. People who buy precious metals are not immune to the same psychological forces that cause individuals to do poorly in the financial markets. It's hard not to get excited during a period of increasing prices or become worried during periods of falling prices. The best thing those of us who lack a crystal ball can do is to maintain discipline. The key is to view price declines as an opportunity to increase purchases and price increases as an opportunity maybe to gradually lighten up, provided there are other investments that offer a more compelling value. As far as costs are concerned, that's the other factor which is totally within your control. A high premium is a very difficult thing to overcome. That's one of the reasons why I don't trade the gold to silver ratio very often. The last time I did so was in early 2011 when I exchanged a large silver position for gold. But those opportunities don't come along often. The higher the premium that you pay for a coin, the longer you should expect to have to hold it. So these are my own personal thoughts, and I hope they'll be useful to you. Feel free to share your own, and have a nice weekend.